If your LLC is finally making money in 2026, but you're not fully confident how to pay yourself without causing tax problems or cash flow issues, you're not doing anything wrong. You're just missing structure. And that's exactly what gets most LLC owners in trouble. Not fraud, not cheating, just doing things loosely. Today, I'm going to show you the clean, IRS-aligned way to pay yourself as an LLC step by step so your money, your taxes, and your business all stay organized. If we haven't met before, I'm Heno Kabeda. I'm a certified public accountant and tax strategist. I work with business owners every day who are profitable on paper, but stressed in real life because they're not sure what's theirs to take, what to leave, and what to reserve for taxes. So let's simplify it. By the end of this video, you're going to have total clarity on how paying yourself as an LLC actually works in 2026. I'm going to walk you through the main way most LLC owners pay themselves without payroll, the exact setup you need so your money stays clean and defensible, the biggest mistake I see that creates surprise tax bills, how the IRS actually looks at LLC income versus withdrawals, and when staying as an LLC makes sense versus when an S-Corp starts coming into the conversation. See, this matters because paying yourself wrong doesn't just affect taxes. It affects cash flow, bookkeeping, and even how protected you really are as a business owner. So if you've ever asked yourself, how much of this money is actually mine to take? This video is going to answer that clearly. If you own LLC, the most common way to pay yourself is through what's called an owner's draw. You'll also hear people call this an owner's distribution. Two different terms, but they mean the exact same thing. And I want to spend a little bit of extra time here because this is where most LLC owners get confused right from the start. An owner's draw simply means you're moving money from your business bank account into your personal bank account so you can actually use it in your personal life. That's all it is. It's not payroll, it's not a W-2 salary, and there is no tax withheld at that moment you move the money. Now, here's where people misunderstand that. A lot of owners hear no tax withheld and assume, oh, that means this money isn't taxable. That assumption is completely wrong, and that misunderstanding is what creates tax problems later. Let me walk you through this slowly with numbers. Let's say your LLC brings in $10,000 this month. Your business expenses for that month are about $4,000. That means your business made $6,000 in profit. Now let's say you move $3,000 from that business account to your personal account. That $3,000 is your owner's draw. But this is the key distinction. The IRS is not focused on this $3,000 transfer. The IRS is focused on this $6,000 profit. So even though you only moved half of the money to yourself, you're still taxed on the full profit. Let me say that a different way, because this is where people trip up. The act of transferring money does not create tax. The profit already did. Whether the money stays in the business account or moves to your personal account, the tax outcome does not change. And this is exactly why separating business money from personal money matters so much. Because the moment you start paying personal bills directly from the business account or using the business debit card for personal spending, you're no longer clearly separating what belongs to the business versus what belongs to you personally. When that line gets blurred, three things get harder very quick. Your bookkeeping becomes messy, your taxes become harder to explain, and your liability protection gets weaker. The clean system always looks like this. Business income goes into the business account. Business expenses get paid from the business account. And when you want personal money, you take it out intentionally as an owner's draw or distribution. That one habit alone eliminates a massive amount of stress for LLC owners. Step one is making sure your LLC has an EIN, which stands for Employer Identification Number. Now, even though the name sounds like it's only for businesses with employees, this step applies to you even if you don't have employees at all. Think of the EIN as the social security number for your business. It's how the IRS identifies your LLC as its own separate entity, not just an extension of you personally. And this matters more than people realize. Without an EIN, everything tends to get tied back to your personal social security number. your banking, your tax reporting, and sometimes even how income is tracked. When you have an EIN, it allows you to operate like an actual business instead of a side account. It's what lets you open a proper business bank account. It's what your CPA uses to report business activity cleanly. And it's what keeps your personal identity separate from your business identity. So even if you're a single member LLC, even if you're just starting, even if you don't have plan to hire anyone soon, having an EIN is a foundational step that makes everything else we're about to talk about work the right way. Step 2 is opening a dedicated business bank account for your LLC. And I want to be very clear here. This is not optional if you want clean finances. See, most problems I see with LLC owners don't start with taxes. They start with banking. A lot of people delay this step because it feels inconvenient at the beginning. They'll say things like, I'm just starting. I'll separate things later. Or it's easier to just use my personal account for now. And the issue is that for now usually turns into months or even years. And the longer business and personal money are mixed together, the harder it is to fix and the more expensive it becomes to clean up. Let me show you why this matters using simple numbers. Let's say over the course of a year, your LLC brings in $100,000. If that $100,000 is flowing into your personal account, here's what happens. Business income mixes with your personal spending. Subscriptions mix with groceries. Transfers mix with actual expenses. Now fast forward to tax time. Someone, either you or your CPA, has to go back through the entire account and try to figure out what was business and what was personal. That takes time, and that costs money too. And it increases the chances of mistakes. Now compare that to a clean setup. Business income goes into a business account. Business expenses get paid from the business account. At the end of the month, you can clearly see how much came in, how much went out, and how much profit is actually there. That clarity is what allows you to pay yourself intentionally instead of guessing. And here's the part people don't think about clearly. Clean banking doesn't just make taxes easier. It also protects you legally and financially. When business and personal funds are mixed, it becomes harder to show that the business is truly separate from you. That separation matters for liability, for bookkeeping, and for long-term growth. So I want you to remember this rule because it simplifies everything. If the money is for the business, it touches the business account. And the only time money leaves the business account for personal use is through a clearly labeled owner's draw or distribution. See, that one habit alone eliminates most of the chaos I see with LLC finances. Step 3 is where everything finally comes together. Actually paying yourself through owner's draw or distribution. Once money is flowing into the business account, this is the step most LLC owners actually focus on first. But it's also the step where people get sloppy if they don't have a system. One of the biggest advantages of an LLC is flexibility. So you don't need payroll. You don't need fixed salary. You do not need to pay yourself on a strict schedule. But you get to decide when you pay yourself and how much you take. But here's the part people misunderstand. Flexibility does not mean randomness. Let me walk you through this with real numbers so it's clear. Let's say your LLC brings in $12,000 per month. Your average business expenses are about $5,000 per month. That means you're left with $7,000 before taxes. Now, that $7,000 is not automatically spendable. A disciplined approach might look something like this. You leave $3,000 in the business to keep cash flowing. You set aside $2,000 for taxes, and you pay yourself $2,000 as owner's draw. That's not accidental. That's intentional. And notice something important here. You didn't wait until the end of the year. You did not guess, and you didn't drain the account just because money was sitting there. You decided ahead of time how much the business needs and how much you safely take. Now, let's flip this to show what not to do. Same numbers, 12,000 coming in and 5,000 going out. But instead of planning, you look at the bank balance and say, there's money there, I'll transfer the whole $5,000 into myself. That feels fine in the moment, but not when you've left no buffer, no tax reserve, and no margin for surprises. That's how owners end up stressed later, even though the business is technically profitable. So here's the rule I want you to remember when it comes to owner's draw. Pay yourself consistently, not emotionally. Owner's draw should be intentional, repeatable, and tracked. And that tracking piece matters more than people think. Every draw should be clearly labeled in your banking and in your bookkeeping as owner's draw or owner's distribution. Not transfer, not miscellaneous. Clear labels make your books easier, your taxes easier, and your life easier. This step, done correctly, is what turns an LLC from money coming in into a business that actually supports you without chaos. Now, let's talk about the biggest mistake I see LLC owners make, especially once money starts coming in. They take too much money too early without thinking through the consequences. And this usually doesn't happen because someone is irresponsible. It happens because the business finally starts working and they feel like they've earned the right to take more. Let me show you exactly how this plays out. Let's say your LLC brings in $100,000 this year. Your total business expenses come out to be $50,000. That means your business made $50,000 in profit. Now, here's where the mistake happens. You look at the bank account and see money sitting there, and you think, I'll just transfer most of this to myself. I'll deal with taxes later. So maybe you move $35,000 into your personal account throughout the year. Here's the problem. Even though you only transferred $35,000, the IRS is still taxing you on the full $50,000 of the profit. So now you owe tax on the money you no longer have easy access to. That's where the stress shows up. And this is the part most people don't think about early enough. Taxes aren't the only thing you need to leave money for. Businesses have timing issues. You might have a slow month. You might have an unexpected expense. You might need to reinvest to keep revenue steady. When you drain the account just because it looks full, you remove your margin of error. Let me say this clearly because it's very important. Profit doesn't mean permission to empty the bank account. Profitable businesses still need cash. The owners who stay calm year after year are the ones who reserve for taxes, keep a buffer, and pay themselves with intention. Not based on emotion, not based on the balance, but based on a plan. This one mistake, taking too much money too early, is what turns a good year on paper into a stressful year in real life. Now, let me tie all this together with a simple real-world example. Let's say your LLC brings in $100,000 for the year. Over that same year, you spend $50,000 on legitimate business expenses. So things like software, marketing, contractors, insurance, and operating costs. That means your LLC ends the year with $50,000 in profit. Now here's where planning makes all the difference. Instead of looking at that $50,000 and thinking, great, I can take all this, a more intentional approach might look something like this. You decide to set aside $15,000 for federal and state taxes. You keep another $10,000 in the business account as a buffer, just in case revenue slows down or an unexpected expense pops up. That leaves $25,000 in there you can safely pay yourself over the course of the year. Now notice what I didn't do. You didn't drain the account all at once. You didn't wait until December and hope for the best. And you didn't guess based on how the bank balance looked on a random day. Instead, you paid yourself gradually, maybe around $2,000 per month or smaller draws early in the year and the large ones as the business became more predictable. And the result? When tax time comes around, the money is already there. The business still has cash. And you're not stressed trying to move money around last minute. That's the difference between reacting to your finances and actually controlling them. All right, now let's talk about one concept every LLC owner needs to understand: pass-through taxation. Most LLCs are what's called pass-through entities, which means the business itself usually does not pay federal income tax. And instead, the profit passes through the business and gets reported on your personal tax return. And this is where a lot of confusion comes from. People assume that taxes are tied to how much money they move to themselves. That's not how this works. Taxes are tied to profits, not withdrawals. Let me put numbers to this so it's clear. If your LLC earns $50,000 in profit for a year, that $50,000 is taxable to you. whether the money stays in the business account or whether you transfer some or all of it to your personal account. So taking an owner's draw does not create tax. The profit already did. And this is why people get caught off guard. They leave money in the business account thinking, I didn't pay myself yet, so I'll deal with taxes later. But the IRS doesn't care whether the money is sitting. If the business made profit, the tax clock is already running. That's why owner's draws needs to be paired with planning, not just transfers. Once you understand this, a lot of confusion around LLC taxes disappear. One of the main reasons people choose an LLC in the first place is limited liability protection. In simple terms, that means the business is supposed to be legally separated from you personally. So if the business gets sued or runs into financial trouble, the liability is generally tied to the business, not automatically to your personal assets. But here's the part that doesn't get talked about enough. That protection isn't automatic just because you filed paperwork with the state. It's supported by how you actually operate the business day to day. When business money and your personal money are mixed together, when personal bills get paid from the business account, when records are sloppy and inconsistent, it becomes harder to show that the business is truly separate from you. Clean banking and clean bookkeeping reinforce that separation. They show that the business stands on its own. So when we talk about things like separate bank accounts, owner's draw, and proper tracking, this isn't just about taxes. It's also about protecting the structure you set up in the first place. So treating the LLC like a real business is what keeps the protection meaningful. As your LLC becomes profitable, you're eventually going to hear the term S-Corporation. And I want to be very clear about this part because S-Corps are one of the most misunderstood strategies out there. An S-Corp is not something you rush into just because revenue went up. It becomes relevant when profit reaches a level where tax structure actually matters. Here's the reason people talk about it. With a standard LLC, all of the profit is generally subject to self-employment tax. With an S-Corp, the income gets split into two parts: a salary, which is subject to payroll taxes, and a distribution, which are not subject to self-employment taxes. That's where the potential savings come from. Not from avoiding taxes, but from structuring income properly. Let me put numbers to this so it's concrete. Say your business nets $120,000 for the year. Under an S-Corp structure, you might pay yourself $60,000 as a salary. The remaining $60,000 could be taken as distribution. Only the salary portion is subject to payroll taxes. That difference is where tax efficiency can show up. But here's the part people gloss over. The IRS requires that the salary be reasonable for the work you actually do. You can't just set it artificially low and call the rest distributions. That's where people get in trouble. This is why S-Corp elections should always be paired with planning, payroll setup, and documentation, not just a form filed because someone on the internet said it was a tax hack. When done correctly, S-Corps can be very powerful. When rushed or misused, they create audits, penalties, and a cleanup nightmare. So here's the question almost every LLC owner asks at some point. How much should I actually be paying myself? And here's the honest answer. There's no universal percentage that works for everyone. Anyone who gives you a flat rule like always take this much is oversimplifying something that depends on real numbers. How much you pay yourself depends on how much your business makes, how much it costs to run, how much you need to reserve for taxes, and how stable your cash flow is. So instead of thinking in percentages, I want you to always think in layers. Layer 1 is covering your business expenses. Layer 2 is setting aside money for taxes. Layer 3 is keeping a buffer in the business. And layer 4 is paying yourself consistently from what's left. Let me put numbers to this so it's concrete and easy to understand. Say your business nets about $4,000 per month after taxes. A structured approach might look something like this. You reserve $1,200 for taxes, you keep $800 in the business, and you pay yourself $2,000. That's not random, that's intentional. And the key isn't the exact dollar amounts, it's the fact that you're deciding before you transfer the money. not after you look at the bank balance. When you pay yourself based on a plan instead of emotion, your finances start feeling unpredictable, even when the business income fluctuates. So let's bring all this together. If you're running an LLC in 2026, paying yourself correctly is not about guessing. It's about structure. Owners' draws and distributions are how most LLC owners take money out of the business. But the taxes you owe are based on profit, not on how much you transfer to yourself. That's why separating business and personal money matters. That's why setting aside money for taxes matters. And that's why having a plan matters. When you understand how this works, you stop second guessing every transfer. Instead of asking, can I take this? You already know what's safe to take and what needs to stay in the business account. Now, everything we covered today is general education. The right way to apply this depends on your actual numbers, your income, your expenses, your estate, and your long-term goals. That's why if you want help building a tax smart plan tailored to your situation, you can book a tax planning consult at yourtaxsavingsblueprint.com. We'll look at your structure, your cash flow, and your tax exposure, and help you put a system in place so this works cleanly year-round. And if this video was helpful, do me a quick favor, like the video and subscribe to the channel, because I break down taxes and business strategy like this every week. Comment LLC below and let me know how you're currently paying yourself. And share this with one business owner who's making money, but still guessing every time they move it. See you on the next one.